More on the market impact now. I want to bring in Chief Investment Strategist at Strategic Wealth Partners, Nate Fisher, along with Gibbs Wealth Management's Aaron Gibbs. And, before we get to the broad market, let me just ask your thoughts on just how deeply these corporations should be getting into politics. I don't know if they've crossed the Rubicon or not, Aaron, but it feels like they're gone really deep, and I'm concerned about it.
Well, I am definitely concerned, but you also can see that, look, how many times have they all been hauled in front of Congress because they're not monitoring their accounts, because they're not, they're not on top of screening and letting in fake accounts. And so they're really in between a rock and a hard place of allowing free speech, but yet getting hauled in front of Congress every 6 months. So I can understand why they may have gone to a more conservative approach of simply taking anything that might be controversial off immediately, perhaps overstepping it, because they're so afraid of regulations hurting their business even further.
Nate?
I would say the big thing here is just these CEOs need to tread lightly, because they're creating an environment where they're not only alienating their shareholders, their employees, but more importantly, their customers. And that's not a good place to be right now.
All right, the market itself, we stumbled out the gate. Buyers did emerge on weakness, and yet the rally, even when we do bounce higher, it remains somewhat selective. Aaron, how are you positioning yourself in this strange market, which on the surface is robust, but there's always a big pocket of huge winners and a whole lot of also-rans?
So one of the things I'm starting to really look at is your risk reward. Given how overextended the broad market is, you've got to start looking at which stocks are more potential for any type of downturn, if we do see inflation, if we do see any type of increase in Treasury yields, as well as any increase in corporate taxes, which could potentially slow down the market next year. So I'm looking more at stocks that can really afford the growth, even if there are higher corporate taxes, and that are a little less extended, particularly in the small cap arena, as we've talked about. But I'd say tread carefully. I really don't feel that you should be following stock pickers who show you Instagram pictures of their Rolexes and use them as investment advice. I really like to warn investors to be careful that the markets don't always go up.
There is a proliferation of superstars emerging on social media who have been making a lot of money in this market. So, of course, I know we've kind of saw this movie before, Nate, but I've always been of the notion you got to be careful, to Aaron's point, but you can't not participate. So how are you positioning your portfolio?
All right, so we're at a difficult situation right now where the market continues to grind a lot higher, and you don't want to have too much cash on the sideline, and you want to be involved. So what we're doing in our client portfolios is we're slowly going through names, taking the position down, where valuation is really defying logic. And when I'm looking at a lot of stocks, I'm always thinking, what's priced in at these levels? And is there more risk to the upside or the downside? And to Aaron's point, I'm seeing a lot of the names that I own, there's more risk to the downside. So that's why I'm starting to take risks down. But I'm not completely out of the market, because I still think we slowly grind higher throughout 2021.
Real quick, I got less than a minute, but you brought up bond yields, Aaron. What's the yield on a 10-year that cracks this bull market? Is it 1.5, 2.5? What number should we really raise a red flag as we break through 1% on the 10-year?
I'd say somewhere around perhaps 2.5, where people might start really reallocating, taking some money from equities and pushing them into bonds and into treasuries. I think we definitely need to see something above inflation for there to be a real reallocation and real worry from equities.